Great. Good evening, ladies and gentlemen, and thank you for logging in for this session of Navigating with HSBC. This is a series that we do to bring to you some of the most interesting ideas in investments. As you would know, there have been a lot of conversation around how the global economy has been shaping over the last few months. A lot of uncertainty, a lot of interesting ideas coming up. But one of the things that really stood out is the broad resilience of markets, especially on the emerging market side, which has really held up to the promise of growth. Like all Indians, we of course have a very strong bias towards India as a market, and a lot of us possibly invest only in India. But interestingly, there are markets around India which are emerging, which are very high growth oriented, and often provide a very interesting complement to Indian investors who invest into largely Indian markets. And to talk about emerging markets, as we call them, and emerging market investing, we are very pleased to have with us Stephanie Wu. Stephanie, thank you for making time and joining us this evening.
Thanks for having me.
Super. Stephanie is the head of global emerging markets and the core Asia strategy for us. And Stephanie, I think I'll jump right into the conversation on emerging markets. So give us your outlook about emerging markets and the investment opportunity there.
Great. Straight into it. So maybe I can go back a little bit though and talk a little bit about myself. I've been investing in emerging markets in Asia for more than 30 years. So lots of white hairs, as you can see. And thinking about today and talking about the asset class really reminded me that the best time for emerging markets was a long time ago, nearly 25 years ago. And at that time, in December 2001, China joined the World Trade Organization, and that was a hugely significant event for the asset class. It unleashed the golden age for emerging markets, a period that was defined by very strong trade flows, by very strong economic growth, and of course, very strong returns to the equity market. If you, Shoaib, had invested back in those days in 2001, you would have made 5 times your money in 6 years. So that's a huge, stellar return. So the question now is, can that repeat? And arguably, it's difficult to repeat that time. But the other question, which I want to explore today, is can emerging markets outperform other asset classes? And we are constructive. We believe that there's some structural drivers as well as cyclical factors which underpin an investment in emerging markets. And just thinking about this year, I mean, this year has been a year that has been dominated by tariff turmoil, by uncertainty about Fed monetary policy, by geopolitical flare-ups in the Middle East. So a lot of noise and a lot of risks. And yet the asset class has delivered more than 16% return in US dollars. And that's beating the S&P 500. It's actually beating the Nifty index, the Sensex index as well. So this is why maybe it's an interesting time to look at the asset class and what the outlook is. But maybe I'll share a couple of slides, if I may, because as you know, we've done an event together and we've got a slide deck, and so maybe it's interesting to people on this platform as well. And so what I want to dive into is why invest in emerging markets equities. And I think some of the most interesting, innovative, and relevant companies for the next decade sit in emerging markets today. We've got companies that are breaking technology barriers in areas such as artificial intelligence, humanoid robots. I've got a little picture there, which I nicked from somewhere, showcasing China's progress in humanoid robots. This is not Elon Musk's Optimus. This is domestic homegrown robot. But also areas like autonomous driving and even autonomous flying. So really cutting edge technology. But also companies in emerging markets are leveraging technology and access to the internet and a very young tech savvy population to bypass or even short circuit the development curve. And here we're thinking about companies that are going enabling economies to move straight from a cash economy to digital finance. And you've seen it yourself in India, right? Everybody's now kind of conducting transactions on their phones. We've seen how economies have moved straight from market-based trading to e-commerce. And so leapfrogging is also an important driver for these companies that are developing innovative solutions. And I think lastly, and this is often overlooked, I mean, IPO markets around the world have been quite moribund in the last year, whereas in emerging markets, they remain very buoyant. We see a steady stream of compelling investment opportunities, and these are there for equity markets, equity investors to capitalize on. So I think really some of the most exciting companies in the world are actually in emerging markets today. But I could have told you this last year as well. And so the question is why now? And I mentioned we've seen some outperformance year to date. But if you think about the asset class, it remains very unloved and overlooked by global investors. And apologies for this messy slide here, but in the bottom left chart, you can see how global investors' allocation to emerging markets has hit a record low at around 5%. I mean, that's about half of what it was 10 years ago. Investors have completely exited this asset class, so unloved and underowned. Valuations are very attractive, so we can see in the bottom right, the valuation discount to US equities, emerging markets trading on about 13, 14 times, S&P on 23 times. So it's a big valuation discount because investors have not been involved here. And then most importantly, we see some strong earnings growth. Emerging markets tend to outperform better when growth is strong, and we see upward revisions to that earnings growth as well. And then lastly, the weak US dollar should provide some further tailwinds to returns from emerging markets. So that's in a nutshell, really, some really attractive growth opportunities, structural growth opportunities in emerging companies, and very attractive valuations. And the asset class is overlooked by global investors.
I think very, very interesting, Stephanie. I think when you talk about structural opportunity valuation, I think they obviously appeal to Indian investors. They obviously in many ways confront similar kind of themes in India. However, I think what we also realize is that in many times the good news, of course, travels much faster, and opportunity, of course, is something that one gets to hear. What are the near-term risks really that you see in emerging markets, and what are your sort of sense of how that would play out over the short term?
Look, Shobal, great question. I mean, there are always a plethora of risks out there. And there are kind of the exogenous risks and endogenous risks to emerging markets. So if you think about the exogenous risks, I think, the tariffs, I mean, so far the news is quite good. Today we've had the announcement from Japan, which came in better than expected. And so it seems like we're kind of past the hump. However, equity markets have become complacent about this. And so there's still kind of perhaps risks related to trade and trade disruptions on the horizon. I think, the US monetary policy, as we know, US inflation could be ticking up. Who knows? Growth may be slowing, so there's some risks around that. And we need the economy in the US to remain strong. I mean, chugging along in the background for EM. And then I think China. China is a huge risk, as you know. The Chinese policymakers have pivoted towards easing, and we can talk about that later. But deflation is still present in China, and so that could remain a risk. But I mentioned endogenous risk as well. And as always in emerging markets, there's always another election around the corner. There's always some kind of policy U-turns. And so we have to be mindful of this. But I think, these risks are kind of the known unknowns, perhaps. And so it goes back to valuation. How much is priced in? How much are you paying? And, for this risk, what kind of a discount are you attaching for this risk? And so we feel today the risk reward is attractive.
No, absolutely. I think the risk reward is what really investors will need to look at when they're investing. When I started off, I spoke about how Indians have a very strong home country bias, and Indian investors are very highly exposed towards India. When you look at emerging markets, one of the challenges that while we have been talking about the diversification theme, clients obviously ask, saying, how do Indian investors sort of use this as an opportunity? Where does this really fit into their own portfolios?
Yeah, I'm not an asset allocator, so I don't really want to talk about diversification benefits. I mean, that's a very specific thing. But I mentioned already we've seen some outperformance of global emerging markets versus Indian equities. And let's hope the India dream run continues, because it's a fantastic story, and India's on a very strong growth trajectory. But I think what it boils down to is, again, the price you pay. And so I look at Indian equities today, and better than I do, the Indian market is trading on 23, 24x. So it's similar to the US equity market. And in fact, you look at the compounded returns, they've been similar as well. But the growth is sort of right now maybe a little bit tepid, you could say. So corporate earnings growth, mid-teens corporate earnings growth, that's the same as you get in emerging markets, but you're only paying 13x. And so whilst I don't want to talk about diversification and the kind of decorrelated assets, because they're not. I mean, they are correlated. I think there's some exciting opportunities outside India, and those opportunities are more attractively valued. And so if you look back, I mean, the dream run has gone on for a long time, but there was a period when India actually wasn't performing that well. And so, who knows? So I think my view would be that it pays to have some other investments in a diversified portfolio, and there are exciting opportunities outside India.
And if I could add to that question in terms of the structural growth opportunities that emerging markets sort of represent, are they slightly different from what you see in India? I mean, I'll assume, Stephanie, that you obviously broadly would have a sense of India because you're also exposed to India in your portfolios. So is it structurally different from what we get to see in India, or is it similar but at a different scale? I mean, how do you define these two markets?
But there's two things, isn't it? One is some of the kind of more exciting, new economies, and it doesn't matter. I mean, in India, be it digital payments, be it like I mentioned before, be it, you look at food delivery, you look at all the kind of new exciting industries that are replacing the old, old economy industries like metals and mining and stuff. So there's all of that happening across emerging markets, and I would argue that perhaps China is perhaps even more advanced in this area than India, and a lot of investment goes into these new economies. But I think beyond Asia, there's a lot of catch-up potential still. And if you think about areas we invest in, such as Sub-Saharan Africa, even some of the Latin American markets, there's this leapfrog potential that I mentioned earlier. And so it doesn't matter whether it's digital payments replacing what traditional banking network that doesn't exist in sub-Saharan Africa. And interestingly, just today, the FT was picked up about Nigeria as a case in point here. Nigeria's GDP was rebased to kind of include all the kind of digital economy that's developing very rapidly and growing very rapidly, and has resulted in a 30% uplift to GDP. And so really two drivers. One is similar developments as in India, new economies, new technologies driving new economies. And that's happening in India, it's happening in North Asia, it's happening in China. And then this kind of catch-up potential and leapfrog potential that we see in non-Asian emerging markets.
I think, Stephanie, thanks for that perspective. I think a corollary to that question, of course, would be when you look at some of these markets, and you mentioned how these markets are often way beyond our own sight, right? I mean, you talked about sub-Saharan Africa, etc. Now, when you choose to invest, are these entities homegrown indigenous opportunities, or are these multinationals who built in infrastructure? They are doing something which is specific to them, or are these a combination of both of this?
It's a combination of both, and I think we would always, because we're very valuation conscious, we always look for the opportunities that are more homegrown, because the MNCs that go tend to be priced as developed companies rather than local companies. And so, we invest in companies, and we can talk about that a little bit maybe when we talk about our investment approach. But we invest in companies that are accelerating digital and financial inclusion, for example, in sub-Saharan Africa. And here it's the telcos that are key enablers of this. And some of those are listed in, for example, in South Africa, some in local markets like Kenya, but also London actually is still a home to some of those companies. And so it's a real kind of mixed bag, but ultimately we look for the most attractive opportunities. And that means not just the growth, but where the growth is not priced in.
I think that brings me obviously the obvious question. You've been speaking about valuation, growth not priced in. I think that seems to be the very pivotal theme of GEM. Tell us a bit more about GEM. Tell us a bit more about what goes behind it. What's the investment strategy, the vision behind putting a fund like this together?
Yeah, great. I'd love to. If you don't mind, I'm going to share again a couple of slides, brings it to life more. So when we talk about the HSBC Global Emerging Markets Fund, it's a high conviction strategy. So that means it's concentrated, it's a bottom-up strategy, concentrated in around 40 holdings. We have a thematic approach focused on 3 investment megatrends: energy transition, digital transformation, and investing with positive impact. And we have a very highly experienced gray-haired team, but most importantly, we really leverage the breadth and depth of HSBC asset management resources. As you know, our company is dedicated to emerging markets in Asia, and we have unrivaled resources on the ground. So that's one thing to note. But what I spoke about, we focus on investment megatrends. And the reason for that is that we've identified 3 trends which are transforming not just economies, industries, but also business model across the world for the next decade or next decades. And so we believe that companies that are aligned with this disruption will enjoy stronger earnings growth, benefit from potential policy tailwinds, and also enjoy multi-year valuation re-rating. So here we go again about valuation. So it's really about very long-term investment horizon versus the markets, which are quite myopically focused in the next 12 months. So let's talk about those mega trends. The first one is the energy transition. And I like to quote Mark Carney, who used to be the governor of the Bank of England, now obviously Prime Minister of Canada. And he once said that the energy transition is the greatest commercial opportunity of our age. And what does he mean by that? We believe this as well. It is estimated that more than $5 trillion of investments are required to meet the net zero targets by 2050 that the world is committed to. Huge investments. And those investments are into decarbonization of energy. So we're talking about renewables and the renewable supply chain. We talk about decarbonization of transportation. So that's new energy vehicles and their supply chain. And then, of course, decarbonization of hard to abate industries like cement, steel, residential housing. And so here we talk about the hydrogen economy. So one of the investment megatrends we invest in is in companies that are aligned with the energy transition and really enabling this. The second one is digital transformation. And of course, AI is on everybody's mind at the moment. And Jensen Huang, the founder of NVIDIA, said, artificial intelligence will impact every industry and every country, and that's it's rapidly unfolding. But I think digital transformation goes beyond just using AI. It's about having digital infrastructure, and again, it's a multi-trillion investment opportunity to build out data centers and the semiconductors and the hardware that's required. It's about the digitization of businesses, how we do businesses, migrating our business to the cloud, automation of businesses, and then also about digital disruption from companies that have got goods or services like financial services or conduct commerce digitally for e-commerce or even online learning or online entertainment. And so this is all under the kind of digital transformation umbrella. And again, companies that are aligned with this trend, we believe, will deliver stronger earnings growth and enjoy long-term valuation re-rating. And then the last trend is perhaps sort of lesser known, and it's what we coin inclusive growth. And it's really about acknowledging that 1.7 billion people in the world are underserved by the institution, and that can be banking, underbanked. It can be lack of access to electricity, lack of access to the internet. And so those 1.7 billion people are primarily located in emerging markets. And there are companies that are expediting the kind of access to kind of financial services, to they're bridging these kind of market failures. And so we believe the companies that are enabling the kind of financial digital inclusion, provision of affordable and accessible healthcare, they're going to be long-term winners because they're very innovative and relevant in the long run. So those are the three investment megatrends we invest in. And the key reason is that we believe those are the most innovative, exciting, and attractive opportunities in our investment universe. How do we do it? I mentioned we have a concentrated, high conviction portfolio of only 40 stocks. And so this is put together in a very kind of disciplined way because we just want to harness returns from stock selection. And we measure and manage our risk exposures, be it to style factors, growth, value, beta, but also to external risk factors such as the US dollar, such as US interest rates, and other potential risk scenarios. So portfolio construction is extremely important for us to kind of deliver returns for this strategy. And then research. Research is the bedrock for our investment approach. We conduct top-down research into those enablers of the investment megatrends that I spoke to. And then we conduct company research, fundamental research. We have a team of more than 40 analysts analyzing companies across emerging markets in Asia. And the key emphasis really, again, valuation. We look for companies where the growth is not priced in yet. We look at companies' valuation in the context of their sustainable profitability. I mentioned portfolio construction is important in order to kind of identify and manage the external risks that we spoke about earlier. And then also as active owners, we engage with companies because we believe as long-term owners, we want to drive better outcome through engaging with the companies we invest in. And then lastly, before I lose your attention, I just wanted to highlight again. So I mentioned we have an experienced team. So we're a team of 4 portfolio managers. We're supported by a very deep bench of research analysts, but also by the broader resources of HSBC Asset Management. And so we have local expertise. As you know, in India, we have a very strong team, not just of analysts, but portfolio managers that we can leverage. We have very strong teams investing in China and Asia, based in Hong Kong. Here on the ground in London, we have an emerging markets debt team, and so we can gain their insights into the macro economic outlook, as well as the frontiers team. And then we have evolving areas of expertise. So here we think about the digital transformation team. We have a transition resources team and sustainable healthcare team. And so we're extremely well resourced, and the GEM team really benefits from the breadth of these resources. So I'll stop here, but this is it in a nutshell.
No, I think definitely what really stands out is when you spoke about inclusion as a mega trend that you look at. That of course is a very standout in terms of an investment idea, and also I think when you say that you bring about capabilities of HSBC Asset Management across the spectrum, and it's not just about people who are dedicated toward this fund. I think both of these really stand out. Given the kind of markets that you look at investing into, which are the countries that you favor? Which are the themes that really you think is playing out at this point in time?
So what I try to say is that we don't really have strong country exposures or kind of style factor exposures, and so we don't think about countries because we invest in companies. We're not the emerging markets debt team. But since you're holding a gun to my head, I'll just talk about a few countries here. And I think I mentioned earlier China. China really is the wild card, and why is that? I mean, firstly, it's 30% of our universe, so it's extremely important. I think China is the reason why emerging markets as an asset class hasn't performed well in the last decade. And so let's unpack that a little bit. China's clocking up, economic growth of 5% per annum, so all seems kind of well, but it's not well. So I think since COVID really started, China has struggled. It's struggled to grow because of its perhaps misguided zero COVID policy, but more importantly because of the property market demise. Property is very important for China's economic growth. The fixed asset investment focused on property has been a key driver. And I think Chinese policymakers have found it hard to pivot away from that fixed asset investment growth towards kind of a more consumption-led economic growth model. I think also maybe the regulation has not been favorable to the major tech companies. And so we saw a derating here. So all of these factors contributed to a derating of the Chinese equity market. And so whilst India was experiencing and enjoying this dream run, China actually derated from mid-teens multiple to low of below 10 times. And so that's kind of in the past. Since early 2024, we've seen a policy pivot. So we've seen some selective easing, monetary policy easing. We've seen some fiscal easing as well. And importantly now, we're seeing the beginnings of perhaps some kind of structural reform as well. So we've just heard about the supply side reform 2.0, which is important. And there's other levers that China can still pull to kind of keep growth on track, but have a more sustainable growth than what they had in the past, which is driven by property. So I said China's the wild card because the jury's out and international investors are quite skeptical. And this is why, valuations in the market are very cheap. If you look at China's, for example, leading e-commerce company, I'm not going to name the name, but it's has an equivalent in the US and it's trading at about, a third of the valuation of the US listed one. And that, there's a plethora of companies I can refer to that are really delivering earnings growth, delivering, technology improvements, very rapid technology improvements, but this is not priced in yet. And I think maybe investors could be wrong. So the DeepSeek moment earlier this year came as a surprise to everyone. The world thought China is excluded from, technology progress, with the kind of Semiconductor Act in the US, the CHIPS Act, and other restrictions. China was really struggling, and yet all of a sudden along comes this never heard of large language model, which was, devised at a much lower cost than what we've seen in the US. And it actually works. And so I think that was the first moment where the spotlight shone on China and said, well, actually, a lot of, technological evolution or revolution is happening. And so I'm not saying that the market will start to rally or deliver the kind of dream run that India's enjoyed, but, valuations are so attractive and people are not focusing on it. So it could be an outlier and the wild card. But Shoaib, really, it's about stocks, and I wonder whether there might be an opportunity to talk about some of the companies that we invest in, or the types of companies we invest in. Is that interesting for you and your listeners?
Absolutely. I was coming. That was my next question. So, what would be your top 3 or top 5 favorite stocks, and why have you chosen to invest in them?
Look, we have a concentrated portfolio, and we only have 40 stocks. So it's asking like, who's your favorite child? So I'm not going to talk about my favorite child, and hopefully you won't either. But let's talk about some of the interesting investment opportunities we've identified. So here's one that is a spin-off from actually an Indian company. It's listed in London, and it's a telecom company that we think is really accelerating financial and digital inclusion. This African telco offers connectivity to more than 160 million customers across 14 sub-Saharan African countries now. They offer mobile money services to 35 million customers. And as I mentioned before, if you're sitting in rural Nigeria or sitting in rural Ghana, you don't have access to banks. And so what this company is doing, amongst others, they're not the only one, is providing QR-based services. You pay in to your wallet, in Lagos, and you send money to your auntie in the village, and it will be instantly paid out by this huge network of agents that they have. So mobile money is a really important enabler of financial inclusion, but it's also really benefiting their bottom line. So we see three pillars of growth here. Still growing subscriber base because penetration is lower, growing data. Sub-Saharan Africa, smartphone penetration is only 45%. And Shobha, you think back to what happened in India when suddenly smartphone prices and indeed connectivity prices fell, and we now have nearly 80% smartphone penetration in India. So this is the kind of catch up I spoke about earlier. And then lastly, the third growth driver being mobile money. And valuations are very attractive because investors are fearful of, the kind of idiosyncratic risk, the election risk, currency moves, etc. And so we are able to invest in these companies at attractive valuation. Here's a Mexican company we like a lot. It's a micro lender, and they follow the kind of traditional, Grameen Bank group lending model to women. And so this is a company that's providing financial inclusion in Mexico. This is a policy imperative, but the banks are not rolling out networks quickly enough. And so Mexican financial inclusion is less than 50%. So it's very low. So we think it's a company that's really enabling that inclusion, not just in Mexico, but also they just expanded into Peru. And so we see a very long runway for growth as financial services penetration increases, and this company is sitting at the epicenter of that development. Here we have the example of a Brazilian ERP company, so enterprise resource planning software. They're kind of like a mini SAP in Brazil, and again, it's about kind of catch up potential because the software spending in Brazil is very low. Penetration of ERP systems is very low. And this is a company that's targeting the small and medium-sized enterprises, and they have 70,000 customers. They have a suite of ERP products. Indeed, they just concluded another acquisition, and so it's a very strong growth story, and it's a great compounding story because 90% of their revenue is recurring. And again, when I say it's not yet priced in, and I know I go back to valuations, it's a company that's trading at 20x earnings for this very long runway for growth. But you look at some of the larger kind of peers, and they're trading at twice the multiple of this company. So again, very attractive opportunity in Latin America. And then since I mentioned China, I wanted to bring up this example here of a Chinese tech company that had some very humble beginnings in the mobile phone production, and I think they have some decent market share in India as well. But they've not only evolved this to be kind of leading edge now. They're developing their own semiconductor chips. They're embracing and embedding AI technology, but they're now also kind of branching out into electric vehicles, and not just a Me Too player here. This is really leading, as you can see from the picture here. Looks like a Tesla, but actually, I'm told, because they don't sell them in the UK, but I'm told that in terms of the dashboard and in terms of the functionality and comfort, it's leading. So we're not in the Me Too phase anymore. This is really cutting edge. And they have connectivity across, the smartphone, the car, and intelligent home. And so this is a company that's kind of developing more and more cutting edge products, and it's a beat and race story. So we think, again, very long runway for growth. So hopefully, Shobal, this gives you a little flavor of the kind of companies that we invest in our fund.
So Stephanie, absolutely. I think what's really interesting is I think the focus on price and the valuation opportunity available. What I really see is the capability to scale. So there's of course a large opportunity to scale the business up, and the reliance on technology, stroke digital. I think these things obviously make a great sense, and an investment case most certainly. So really appreciate you talking to us about that. I didn't realize that you only spent 30 minutes talking, Stephanie.
Sorry, I don't know how long we have.
No, this is a fascinating conversation. I think we're coming to the close of this conversation, and I have one interesting question which I have got from one of our viewers. So I'll get the question to you. It says, who shall benefit more from the AI wave? The chip fabricators or the chip designers? So all your Stephanie.
That's a really tough question, and one you should have fielded. Who will benefit most? So again, I mean, I sound like a broken record, but it's all about valuation. And if we think about, and I'm sorry to go back a little bit here, if we think about the original AI moment, that moment in May 2023 when Jensen Huang came out, and we saw obviously very sharp share price rally in that company, and then what we saw was huge tailwind for companies that kind of picks and shovels of AI. We had no idea how this kind of mega trend will manifest, and so investors just piled into anything that could benefit from it. I think we're kind of now beyond that point, beyond the kind of picks and shovel kind of moment. And now we've got DeepSeek, so we've got the question about China AI versus US AI, or what is AI, and how will AI manifest? And so I think the conversation is, I mean, it's a great question, but I think it's a much deeper one than that. It's who will be disrupted by AI, and so we have to think about the valuation companies or industries that are going to be at the epicenter of disruption, and who are going to be the ones who enjoy the longest and strongest growth momentum, and where this is not priced in yet. So I, in a very long-winded way, I avoided to answer the question, but I think there are beneficiaries along that value chain. It's just thinking about where is it not priced in yet.
No, no, interesting. I think from an investment point of view, this is exactly what we're looking at, right? Where is this not priced in, and hence the valuation is attractive, and then that's where returns shall come in. When we started this conversation, Stephanie, you spoke about the Nifty, and I was speaking about the India bias. So we would want to end this conversation with that same thought. So tell us a bit about how does the emerging market, the global emerging market fund performance equate with what the Indian equity markets have been doing. I know you mentioned during the conversation about it being slightly tepid, especially earnings, etc. But from a performance point of view, how is this fund sort of correlating to what's happening on the Indian equity market side?
Okay, so I've got some performance slides. Are we allowed to share them, Shoibal? Is that
Sure,
okay?
sure, please, yes,
Okay,
of course.
great. Yeah. Because I feel, one second. So I'll talk about the near-term performance of the fund, which you can see here. So in year to date, we're kind of small ahead at the benchmark, and the Indian market year to date, I think, is up maybe. We think about MSCI emerging markets, by the way. So that includes 24 markets in emerging markets. India is one of those with around 20% allocation. So year to date, our fund, this is in the first half of the year, is up around 16%. So we beat the benchmark a little bit. MSCI India was only up maybe 5% in this period. And so we've seen a decoupling of the fund performance, alpha generation, but also versus the Indian market. Over the last 5 years, the fund is more or less in line with the benchmark, so not particularly interesting. And I would say that this period is perhaps not indicative of the kind of alpha we want to deliver. So let me go to this page here and look at the long-term returns. And so in the period from 2016 to 2020, 5 years from 2015 to 2020, the fund returned 115%, the index about 80 something percent. So we outperformed very strongly in this period. And it was really down to stock selection. Those positions in these high conviction holdings that we have helped us to out deliver by around 26% during this period. And then, as you can see, I highlight in red here, we had a bit of an air pocket. And going back to your question, that air pocket was actually related to India. So I mentioned to you before that we're fundamental investors and we're very valuation conscious. So in 2023 and 22 to 23, the Indian equity market re-rated from around 20 times to as high as 26 times earnings. And during that period, the Chinese equity market derated from mid-teens to less than 10 times. And even though we don't take significant country bets, the stocks that we had were less geared into this re-rating in India, less momentum, and perhaps too fundamental. And again, in China, suffered derating, even though those companies delivered on their earnings. And so, like I said, I see that this period was a period of maybe extreme dislocation. Like I said, from 20 to 26 times and from mid-teens to 10 times. And now we see perhaps kind of normalization of valuations again. And so, in summary, even though in the very recent past we haven't out delivered versus the benchmark or versus India, we feel that our investment approach, which is fundamental, based on a proprietary analysis and looking at valuations in the context of sustainable profitability, we believe that that approach will prevail in the long run.
Super, Stephanie. I think and that's been a very, very insightful response. Often, I think we get carried away by immediate outcomes. So when you look at
Yes,
performance indices, but the way to look at it, of course, is long term, and especially in the context of volatility, in the context of unseen events, which you may not really see in a graph. So, thank you, Stephanie. I think a very very engaging conversation, Stephanie. I haven't. I did not, of course, know of the insights as much as I got to know of the fund today. We are very excited. So, thank you for taking time and talking to us. We are, of course, very, very keen that our clients sort of invest and take advantage of this opportunity. And you can rest assured, Stephanie, we'll reach out to you again at some point in time for more questions. Thank you.
thank you so much for having me.
Really appreciate it. Thank you.
Bye.